The payments industry moves fast. The economics behind it move even faster. Welcome to On the Wire, a show about the economics of payments, the institutions moving money, and the infrastructure underneath it all. This episode is produced by payware using AI voice synthesis, built from primary research, technical documentation, and real market data. No studio, no hosts, just the content, clearly presented. Let's get into it.
You know that feeling when you're watching a slow leak in a boat?
Oh, yeah, definitely.
At first, it's just a puddle, right?
Yeah.
You bail it out with a cup. But then the water starts rushing in.
Yeah.
And you realize, wait, we are actually sinking. Welcome to your custom deep dive. And today, that sinking boat is exactly what mid-sized banks are dealing with in the business case you brought us.
Yeah, so that leak is basically the massive squeeze on traditional card margins right now. I mean, regulators have totally capped interchange fees.
Right, so banks are making way less on every single swipe.
Exactly. And at the exact same time, you've got these agile fintechs siphoning off their merchants. So the old buckets, well, they just aren't working anymore.
But looking at your sources, there is a lifeline here, which is account-to-account or A2A payments.
Right.
Our mission today is to figure out how integrating a network like payware's A2A system can actually flip those declining margins into this massive growth engine. But obviously they have to build it first. So what does that initial pain period look like?
Well, it's definitely a heavy investment up front. So integrating the payware infrastructure costs nearly 800,000 euros.
Wow. Okay. That is steep.
Yeah, and it takes about 6 to 9 months of real heavy lifting. So year one is basically just a building phase. You are looking at a net loss of, well, over 700,000 euros.
Ouch. Yeah, I like to think of it kind of like installing commercial solar panels.
Oh, that's a really good way to look at it.
Right, because there's this huge upfront cost to get the panels on the roof, but then suddenly you're entirely bypassing the traditional grid.
Which in this case is routing payments completely outside those legacy card networks. And being off that grid means the payback period is just aggressively fast.
How fast are we talking?
So by year two, the bank is capturing over 1.5 billion euros in A2A transaction volume.
Wait, billion with a B?
Billion with a B, yeah.
What?
And because they charge this really lean, 0.5% fee on that volume, they end up generating almost 10 million euros in net profit.
So they hit their break-even point in, just 14 months?
Exactly, yeah, 14 months.
That is incredibly fast.
It is. But breaking even quickly is really just the start. The 5-year financial projections are what totally changed the bank's valuation here.
Okay, lay the 5-year numbers on me.
By year 5, the bank hits over 30 million euros in annual A2A revenue.
Wow.
Yeah, and over that whole 5-year span, the total net return on investment reaches almost 100 million euros.
Okay, wait, hold on. An ROI over... it says 12,000% in 5 years. That sounds like a crypto scam to me.
I know, right? It sounds totally made up.
I really have to push back on these sources. Is a projection like that actually realistic in the real world?
It sounds absurd, I know. But the math actually relies on highly achievable merchant adoption. The model only assumes hitting 25% of the bank's current merchant base.
Okay, 25% seems doable. But why would merchants jump on board so fast?
Pure cost savings, honestly. A2A saves them up to 83% on processing fees.
Oh, wow. 83% is huge.
Right. Plus, it completely eliminates their PCI compliance burden.
Let's pause right there. Why does it eliminate the compliance burden entirely? That seems like a massive deal.
It is. It's because A2A pushes money directly from the customer's bank account to the merchant's bank account.
Oh, so the merchant never actually touches a credit card number.
Exactly. No card data means there is literally nothing for hackers to steal. So that massive, super expensive headache of securing card networks, it just vanishes for them.
Okay, yeah. So the math really starts to work when you realize how strong the value proposition is for the merchant. Hitting 25% adoption suddenly feels way less like a pipe dream.
For sure.
But looking at your notes, the direct revenue from those transactions isn't even the only major win here, is it?
Not at all. The real strategic advantage is actually stopping merchant churn.
Which is a huge problem for banks right now.
Oh, massive. Without an A2A offering, banks are losing roughly 12% of their merchants every single year to cheaper competitors. But when a bank integrates A2A, that churn rate plummets to under 4%.
That is a crazy drop.
Yeah. And by keeping those merchants around, the bank retains almost 12 million euros in revenue over 3 years. It effectively triples the lifetime value of a single merchant.
It's like offering just standard card processing is like selling bottled water.
How so?
Well, merchants will swap you out the second a cheaper brand appears on the shelf.
Right.
But combining their everyday business banking with this A2A payment infrastructure, that's like installing their plumbing.
Oh, I totally see that.
It's this deep foundational relationship that handles their core cash flow. They aren't going to just rip their plumbing out because someone offered a slight discount.
Exactly. And that plumbing comparison actually goes even deeper because of the visibility it gives the bank.
Right, the data.
Right. Processing direct account transfers gives the bank access to real-time payment data. They aren't waiting days for those delayed card settlements anymore.
So they can see everything instantly.
Yeah, that to-the-second visibility into a merchant's cash flow lets the bank intelligently cross-sell lending and treasury services, exactly when the merchant actually needs them.
So what does this all actually mean for you as you review this deep dive? The ultimate takeaway from your sources is that adopting A2A is not just about offering some shiny new feature on a banking dashboard.
Definitely not. It's a dual strategy, really. It's defensive survival to stop the bleeding and massive profitability to fuel the future.
It really is the difference between going down with the ship and building an entirely new, faster vessel.
Exactly.
Which leaves us with one final thought for you to mull over. If merchants are saving over 80% on fees and banks are generating a 12,000% ROI, well, someone in the financial ecosystem is losing billions of dollars.
That is a very good point.
So how long until the traditional card networks aggressively strike back against A2A? The leak in the boat might be fixed for now, but the water out there is about to get very, very choppy.
That's On the Wire, produced by payware, the transaction resolution network for instant A2A payments. This episode was AI generated from payware's published research and documentation. If something sparked a question, the full source material is available at payware.eu. If you work in payments at a bank, an ISV, or a merchant organization, and what you heard is relevant to what you're building, reach out. The conversation doesn't have to stop here. Subscribe to On the Wire wherever you listen to podcasts. The next episode is already waiting.